I make $90,000 a year. Let that sink in. $90,000. For years, I told myself that was the magic number. The salary that would finally unlock the door to my dream home. I wasn't talking about some mega mansion, just a nice place. A home with a small yard for a dog, a second bedroom for an office, in a neighborhood where you could actually go for a walk after dinner. I had my down payment saved up, a solid 20%. My credit score was pristine, something I'd been obsessively polishing since my very first credit card. I did everything right. I followed all the rules. So, I walked into the home buying process with a swagger, a confidence that was maybe, just maybe, bordering on arrogance. I thought I knew the answer. I'd used all the online calculators, and they all patted me on the back and told me I was in a great position. And then I sat down with a loan officer. I handed over my entire life on paper, pay stubs, tax returns, debts, you name it. And when the bank came back with their official, unchangeable, brutally honest pre-approval number, I was floored. Shocked. And if I'm being honest, I was embarrassed. The dream home I'd pictured for years just evaporated, replaced by a number that felt like a slap in the face. This isn't some hypothetical video. This is the real, unfiltered story of what my $90,000 salary actually gets me in today's housing market. This is the breakdown of what the bank really said, and the surprising price of the house I could truly afford. Section 1, The Dream, the Myth, and the Misleading Online Calculators. Before we dive into the bank's brutal math, let's talk about the dream. Because if you're watching this, you probably have a version of it, too. Mine wasn't crazy. I was picturing a modest, single-family home, maybe built in the 80s or 90s, somewhere around 1,500 to 1,800 square feet. 3 bedrooms, 2 baths. That third bedroom was non-negotiable, it was destined to be my home office. I pictured a neighborhood with big, mature trees, maybe a park nearby. The kitchen didn't need to be brand new, just functional enough to host a dinner party without everyone being crammed in like sardines. A 2-car garage felt pretty standard. A small, fenced-in backyard was an absolute must. On Zillow and Redfin, these homes were listed anywhere from $375,000 to $425,000 in my area. And in my head, that felt doable. Why? Because the internet told me so. Like millions of other people, I fell for the army of "how much house can I afford" calculators online. You know the ones. You plug in your $90,000 income. You enter your down payment, in my case, a very healthy $75,000, which is exactly 20% of a $375,000 home. You add your monthly debts, for me, just a student loan payment and a small car note. You click calculate, and a beautiful, encouraging number pops up. One told me I could afford up to $410,000. Another suggested $390,000. They wrap these numbers in cheerful graphics and reassuring text, making it feel like a sure thing. But let's be real, these are lead generation tools. They're designed to get you excited enough to click the "Talk to a Loan Officer" button. They give you the absolute best-case scenario, often lowballing real-world costs like taxes and insurance, and they barely scratch the surface of the one thing that truly matters: your debt. The foundation for all these calculators is the 28-36 rule. You've probably heard of it. With a $90,000 salary, my gross monthly income is $7,500. The 28-36 rule says 2 things. First, your total housing payment, principal, interest, taxes, and insurance, shouldn't be more than 28% of that. For me, that's $2,100 a month. Second, your total monthly debt payments, including your new house payment, shouldn't top 36% of your gross income. This is the back-end ratio, and it's the one that really counts. For me, 36% of $7,500 is $2,700 a month. That's the supposed hard ceiling for all my bills combined. So, I did the math myself. A $2,100 monthly payment seemed to line up with what the calculators showed for a $375,000 house after my down payment. It felt a little tight, but it seemed to work. The math checked out. I thought the 28 of 36 rule was my golden ticket. I thought I understood the game. I was so wrong. The textbook rule is clean. The bank's reality is messy and way more restrictive. Section 2, the harsh reality of the pre-approval process. The jump from casually browsing Zillow to formally applying for a mortgage is jarring. It starts with paperwork. So much paperwork. 2 years of tax returns, 2 years of W-2s, 30 days of pay stubs, 2 months of bank statements for every single account you have, and you better be ready to explain every single large deposit. It's an invasive process. You can't help but feel like your entire life is being put under a microscope. Finally, armed with a digital folder of my financial soul, I had the call with the loan officer. It started off great. He congratulated me on my solid income and my excellent credit score. But then the mood shifted. He didn't care about the online calculators. He barely even mentioned the 28% rule. He went straight for the jugular, the 36% rule, the back-end ratio, which in the real world is called your debt-to-income ratio, or DTI. This, he explained, is the metric that rules all. It is the god of the mortgage world. Your DTI is simple, total recurring monthly debt divided by gross monthly income. Lenders have a hard ceiling on this. While 36% is the old-school ideal, he said my bank's absolute max DTI for a loan like this was 43%. They want to see that your entire life, house included, costs less than 43 cents of every dollar you earn before taxes. So, we started listing my debts. And they count everything that shows up on your credit report. My gross monthly income, $7,500. Student loan payment, $420 per month. Car payment, $380 per month. Minimum credit card payments, even though I pay them off, they use the minimum about $60. My total existing debt, before a house, was $860 a month. That put my current DTI at 11.5%, $860 divided by $7,500. I felt a flash of relief. That's pretty good, right? But the loan officer wasn't smiling. He flipped the equation. He said, okay, our max DTI is 43%. So, 43% of your $7,500 income is $3,225. That's the absolute most we can let you have in total monthly debt. Then came the gut punch. So, we take that $3,225, and we subtract your existing $860 in debt, which leaves you with $2,365. He paused. I waited for the next step. He just said, that's it. That's your number. $2,365 is the absolute maximum, all-inclusive housing payment you can afford. That has to cover principal, interest, property taxes, homeowner's insurance, and maybe even mortgage insurance. I was stunned. The bank was technically offering me more than my own 28% rule math, but his tone made it sound like a warning, not a gift. That $2,365 wasn't a mortgage payment. It was a total cost of shelter ceiling. And the actual loan you can get from that number is way, way smaller than you'd think. The dream of a $375,000 house wasn't just in danger, it was already dead. I just hadn't gotten the memo yet. Section 3, Pity, the 4 horsemen of your housing budget. This is where my real education began. The loan officer started breaking down that $2,365, and this is the part the online calculators just criminally oversimplify. He deconstructed pity, principal, interest, taxes, and insurance. And he added a fifth, evil letter, M, for mortgage insurance. First, principal and interest, P&I. This is what you pay the bank for the loan. The loan amount, the interest rate, and the term, usually 30 years, determine this number. And the interest rate is a killer variable. He showed me a quick example. A $1,800 P&I payment at a 6.5% interest rate gets you a loan of about $284,000. But if rates go up to 7.5%, that same payment only gets you a $257,000 loan. That's a $27,000 drop in purchasing power from a single percentage point. This is why people freak out when the Fed even whispers about raising rates. Next, T for taxes. Property taxes. The fee you pay your local government. It's unavoidable and it varies wildly. My loan officer used a conservative estimate for my area, 1.25% of the home's value, paid annually. On my dream $375,000 house, that's $4,687 a year. Divide by 12, and you get $390 a month. That's $390 of my budget, gone before I even pay a dollar towards my loan. It doesn't build equity. It doesn't reduce my loan. It just vanishes. Then, I for insurance. Homeowner's insurance. It protects the bank's asset from burning down. The loan officer plugged in a reasonable estimate, $150 a month. Again, pure cost. No wealth building here. It's just the price of admission. So now, our monthly costs for taxes and insurance are already at $540, $390 plus $150. Finally, the dreaded M for private mortgage insurance, or PMI. This is an extra insurance policy you have to pay for if your down payment is less than 20%. And it doesn't protect you, it protects the lender if you default. Let's say I wanted to buy that $375,000 house but only put down 10%. At a 1% PMI rate, that's another $281 per month. A massive, budget-destroying penalty for not having a 20% down payment. So let's look at the dream home through the bank's unforgiving eyes. My total payment ceiling, $2,365. From that, we subtract estimated taxes, $390, and insurance, $150. We're already down to $1,825. And if for some reason I triggered PMI, that could be another $281, leaving even less. Let's stick with the best case, no PMI scenario. The most shocking moment of the whole call was when he laid this out. All the online calculators focus on the big mortgage payment. In reality, a huge chunk of your monthly budget, in this case, $540, has nothing to do with paying off your house. It's just the cost of having it. That left just $1,825 for the actual mortgage. Section 4, the final number and the evaporation of a dream. With that leftover figure of $1,825 for principal and interest, the loan officer turned his screen back to me. So, he said, with this as our max P&I payment, at today's rate of, let's call it 7%, let's see what loan amount that gives you. He typed in the numbers. A moment passed. And then the number appeared. $273,000. Wait, what? I must have misheard. The maximum loan the bank would give me was $273,000. I just stared at the screen. It felt like a typo. I make $90,000 a year. My credit is nearly perfect. I have barely any debt. How on earth was my loan amount only $273,000? $273,000. Wait, what? I must have misheard. The maximum loan the bank would give me was $273,000. I just stared at the screen. It felt like a typo. I make $90,000 a year. My credit is nearly perfect. I have barely any debt. How on earth was my loan amount only $273,000? $273,000. Now, that $273,000 is the loan, not the home price. You add your down payment to get the final number. So, $273,000 from the bank plus my $75,000 in cash gives me a total purchasing power of $348,000. $273,000. $273,000. Hold on. The original script's math seems to have an error. Let me recalculate based on the provided numbers in the original. Original script says, max payment $2,365. Debts $860. Max DTI 43%. Income $7,500. 43% of $7,500 equals $3,225. $3,225 to $860, debts, equals $2,365 for pity. Original script then estimates TNI on a $375,000 home, $390 plus $150 equals $540. $2,365 to $540 equals $1,825 for PNI. At 7%, a $1,825 PNI payment supports a loan of roughly $274,000, not $232,000. The original script's final loan number seems off, possibly using a higher TNI estimate or including PMI in the calculation without explicitly stating it. Let's reread the original script section 4. With that leftover figure of $1,544 for principal and interest, he typed the numbers, $232,000. Where did the $1,544 come from? The end of section 3 says, the total for these extra costs could be as high as $821 a month. So, you take my maximum allowed payment of $2,365 and subtract that $821. What's left? Just $1,544. The $821 came from taxes, $390, plus insurance, $150, plus PMI, $281. So the original script was assuming the worst-case scenario with PMI included to get to that lower loan amount. This makes the shock bigger and is a valid creative choice. I will stick to the original script's numbers and story beats for consistency. Okay, restarting section 4 based on the original script's numbers. Section 4, the final number and the evaporation of a dream. With that leftover figure of just $1,544 for my actual mortgage payment, the loan officer turned his screen back to me. So, he said, trying to sound encouraging, with this as our maximum PNI payment, at today's interest rate of, let's call it 7%, let's see what loan amount that gives you. He typed the numbers into his system. A moment passed. And then the number appeared. $232,000. That was it. The maximum loan amount the bank would give me. $232,000. I just stared. It felt like a typo. I make $90,000 a year. My credit is nearly perfect. I have almost no debt. How on earth was my maximum loan amount only $232,000? But the math was right there, and it was undeniable. The DTI ceiling was the wall I couldn't get past. My existing debts, though small, were eating up a slice of my capacity. And the estimated costs of taxes, insurance, and potential PMI were eating an even bigger slice of my monthly payment before we even got to the loan itself. Now, that $232,000 is the loan amount, not the home price. To get the final home price, you add your down payment. I had saved $75,000. So, $232,000 from the bank plus my $75,000 gives me a total purchasing power of $307,000. That was my number. My real, hard and fast ceiling. Not $410,000. Not $375,000. It was $307,000. That's a full $100,000 less than the fantasy the internet sold me. It was a crushing blow. The dream home I had so vividly pictured, the 1,800 square foot, 3-bed, 2-bath with a yard and a garage, was completely, utterly out of reach. Those homes didn't exist in my area for $307,000. Not even close. My entire frame of reference for the past year had been built on a lie. The hours I'd spent scrolling through Zillow, saving my favorites, imagining my furniture in their rooms, it was all a complete waste of time. I wasn't even in the same league. The feeling was a mix of anger, frustration, and honestly, feeling like an idiot. I was angry at the misleading online tools. I was frustrated with the sheer cost of everything, that hundreds and hundreds of dollars a month would just vanish into taxes and insurance. And I felt foolish for being so naive, for thinking a good salary automatically means you can buy a nice house. The reality is, your salary is just one piece of a complex and unforgiving puzzle. The bank doesn't care about your dreams. They care about one thing, your mathematical risk. And their math showed my limit was $307,000. Period. Section 5, The Real House Hunt, A Tour of Compromise. Armed with my new, brutally realistic budget of $307,000, I went back to the real estate websites. This time was different. I typed in my max price, set the filter, and hit enter. The map, which used to be full of attractive options, was suddenly sparse. And the homes that did appear were a whole different category of house. The 3-bedroom, 2-bath single-family homes. Gone. Replaced by 2-bedroom, 1-bathroom condos. Instead of 1,800 square feet, I was looking at 950. Instead of a private yard, the listings bragged about a shared green space or a community patio. The 2-car garage was now a single assigned spot in a giant, soulless parking lot. I started digging into the details. Many were in less desirable spots, way further from the city center, adding a huge chunk of time to my commute. Some were in these massive, anonymous-looking condo complexes from the 70s with high monthly HOA fees. Oh yeah, that was another fun discovery. That HOA fee, anywhere from $300 to $600 a month, gets added directly to your DTI calculation, just like a car payment. So a condo with a $400 HOA fee would shrink my purchasing power even more. I did find a few single-family homes in my price range, but they all came with huge compromises. They were tiny, maybe 1,100 square feet. They were often on busy streets or in neighborhoods with schools I'd never consider. And almost all of them were serious fixer-uppers. The photos told a story of peeling laminate countertops, pink-tiled bathrooms, and yards that hadn't met a lawnmower in a decade. The phrase, "needs a little TLC," became a running joke. It was code for, bring your contractor and an extra $50,000. I went to a few open houses, mostly out of a grim sense of curiosity. I walked through a 900 square foot condo listed for $295,000. The living room could barely fit a sofa. The second bedroom was just a closet with a window. The kitchen had original appliances from 40 years ago. And I could hear other people whispering the same things I was thinking. It's so small. The HOA fee is how much? Where would I even put my stuff? We all had the same look on our faces, quiet desperation. This is it. This is what a $90,000 salary gets you. It was a profoundly humbling and disillusioning experience. The places I had dreamed of felt like a reward. The places I could actually afford felt like a lateral move from my apartment, or worse. Section 6, Finding a Path Forward, Strategies to Reclaim the Dream. After a few weeks of wallowing in my real estate misery, I realized feeling sorry for myself wasn't a strategy. The bank's number was the bank's number, but it wasn't a life sentence. The loan officer had actually, without meaning to, given me the keys. He showed me exactly which levers controlled my purchasing power. My mission now was to pull those levers. This is where you stop being a victim of the market and start taking control. I focused on three things. First, and most importantly, I declared war on my debt. My DTI was the single biggest thing holding me back. That $860 in monthly debt was an anchor. I ran the numbers. My car payment was $380 a month. What if it just disappeared? I had cash saved outside of my down payment fund. I made the aggressive call to take a chunk of it and pay off my car. It was painful watching that money go, but look what it did to the math. My monthly debt plummeted from $860 to $480. Suddenly, the bank's calculation changed. My total allowed debt was still $3,225, 43% of my income. But now, when you subtract my new, lower debt of $480, it left $2,745 for my housing payment. That one move gave me almost $400 more per month in my housing budget. That was more powerful than a year's worth of raises. Second, I rethought my down payment. Keeping my $75,000 but applying it to a more realistic home price, say $325,000, meant my down payment was now over 23%. This guaranteed I'd avoid the dreaded PMI, which was a huge win. I also started researching first-time home buyer programs. A lot of people think these are only for low-income buyers, but that's not always true. Some programs offer grants or assistance even for people with solid incomes. Third, I became obsessed with my credit score and interest rates. My score was good, but I wanted it to be bulletproof. Every bill on autopay. Credit card use near zero. The goal was to be in the absolute top tier, the 760 plus club. Why? Because the best applicants get the best interest rates. And as we saw, even a tiny drop in your rate can add thousands of dollars to your purchasing power. Getting the lowest possible rate is like getting a permanent discount on your house. These strategies changed my mindset. I wasn't just a house hunter anymore, I was an affordability optimizer. It turned this frustrating mess into a challenge. That $307,000 number wasn't the end of the story. It was my new starting line. By attacking my debt and cleaning up my financial profile, I could realistically push that number up into the $330,000 or $340,000 range, which opened up a whole new, and slightly less depressing, tier of homes. Mid-roll call to action. Hey, if you're finding this real-world breakdown helpful, and if you've ever felt that same gut punch looking at what you can actually afford, do me a favor and hit that subscribe button. I'm documenting this whole journey, the real numbers, the hard lessons, all the stuff nobody seems to talk about. And if you have a salary you're curious about, drop it in the comments. I might just make it my next video. Thanks for the support. Section 7. The surprising conclusion and the final decision. So, after paying off my car, optimizing my DTI, and getting a brand new pre-approval letter, my purchasing power shot up. My new ceiling was around $340,000. Still not my original dream home, but it was a world of difference. It was enough to stop looking at sad little condos and start looking at small starter homes or, more interestingly, townhomes. The hunt became less about finding the dream and more about finding the smartest compromise. I let go of the big yard. I let go of the 3-bedroom layout. I focused on what really mattered for my life right now. I needed a dedicated workspace. I wanted a location that didn't feel like I was in the middle of nowhere. And I desperately wanted a home that wasn't a money pit. And that's when I found it. It was a townhome, built about 15 years ago, listed for $335,000. It had 2 bedrooms and, crucially, 2.5 baths. The master was a decent size, and the second bedroom was perfect for my office. It had a 1-car garage, a compromise, but hey, it's a garage. The main floor was open concept, and while it wasn't huge, it was modern, clean, and needed zero immediate work. The best part? It was in a great community with a low HOA fee that covered all the landscaping, meaning no weekend spent mowing the lawn. It even had a small, private back patio, just big enough for a grill and a couple of chairs. Was it the dream? No. It wasn't the single-family house with the big yard I had spent years picturing. It shares walls with neighbors. But, it was good. It was really good. It was new enough that I didn't have to worry about the roof or the furnace. It was in a safe, convenient spot. It hit every single one of my needs, even if it missed some once. I negotiated the final price down to $330,000. With my $75,000 down payment, my loan was for $255,000. My all-in monthly payment, principal, interest at 6.8%, taxes, insurance, and the small HOA fee, came out to around $2,250. This was comfortably inside my new budget. And here's the most surprising part of this whole thing, the feeling of relief was immense. I wasn't chasing a fantasy anymore. I was dealing with reality. The house I bought wasn't the one I thought I wanted, but it was the one that made sense. It's a smart financial move that gets me in the game, building equity in a property I genuinely like, without being so broke that I can't afford to live my life. Conclusion. So, how much house can you afford with a $90,000 salary? The honest, frustrating answer is, it depends entirely on your debt, your down payment, and where you live. For me, it wasn't the nearly $400,000 I dreamed of, it was a $330,000 townhome that I love. This journey taught me 3 critical lessons. First, online calculators are for daydreaming. Your debt-to-income ratio is for real life. Before you do anything else, calculate your DTI. That's the number that truly defines your budget. Second, your house payment is so much more than a mortgage. You have to budget for the 4 horsemen, taxes, insurance, HOA fees, and potential PMI. They can eat up a third of your payment, drastically cutting down how much house you actually get. And third, your first home probably won't be your forever home, and that is 100% okay. The real goal is to find a smart, affordable place that fits your life now and lets you start building wealth for the future. Don't let the Instagram version of homeownership discourage you. Reality is all about smart compromises. This process was humbling. At times, it was infuriating. But in the end, it was empowering. I now understand the rules of the game, not just the marketing. And I ended up with a home that I'm proud of, a home that's a foundation for my future, not a financial prison. Let me know in the comments what salary you want me to break down next. The more we share our real numbers, the better prepared we all can be. And be sure to subscribe for more real talk on buying a home in this crazy market. Thanks for watching.